Withholding tax is one of the most confusing parts of the tax system for Canadians. Many people assume that if tax is withheld, the tax is already paid and settled. That's not how it works. In this video, we'll explain what withholding tax is, why banks and employers withhold it, and why it's often different from the actual tax you owe. Let's start with what withholding tax really is. Withholding tax is an estimate. It's money taken off your income before you receive it and sent to the government on your behalf. Employers do this on paychecks and banks do it on certain withdrawals. The key word here is estimate. Banks and employers don't know your full financial picture. They don't know your total income, your deductions, your credits, or what other sources of income you have. So instead of waiting until tax time, they withhold tax upfront based on set rules. This is meant to prevent people from reaching tax season and suddenly owing a large amount all at once. But withholding tax is not your final tax bill. Your actual tax bill is calculated when you file your tax return. That's when all your income is added together and your deductions and credits are applied. At that point, the government compares two numbers: how much tax you actually owe versus how much tax was already withheld. If too much was withheld, you get a refund. If not enough was withheld, you owe the difference. This is where confusion usually comes in. For example, when you withdraw money from an RRSP or RRIF, the bank withholds tax immediately. That withholding rate depends on the size of the withdrawal, not your income level. If your actual tax rate is higher than what was withheld, you'll owe more at tax time. If it's lower, you may get some of that withholding back as a refund. The same thing happens with employment income. Your employer withholds tax assuming a standard situation. But if you have multiple jobs, investment income, or pension income, the total tax you owe may be higher than what was withheld. This is why some people are surprised to owe money even though tax was taken off all year. It's also why some people receive refunds every year. A refund doesn't mean you paid no tax. It means you paid more than you needed to throughout the year. Another common misunderstanding is thinking withholding tax is optional or adjustable. In most cases, it's required and follows government tables. The only way to change the outcome is through planning, not by avoiding withholding, but by understanding how it fits into your overall tax picture. The most important takeaway is this: withholding tax is not your final tax bill. It's a prepayment. Your real tax bill is calculated when you file your return. Understanding this helps explain why refunds happen, why balances owing happen, and why tax time surprises are so common. This content is for educational purposes only and not financial or tax advice. If you found this helpful, consider subscribing for more clear explanations of Canadian personal finance topics.